If you observe carefully the markets at the end of 2025, you'll see something that almost no one is discussing with the necessary seriousness. Silver has moved from the $29 per ounce range at the beginning of the year to levels above $70 in December. This isn't just an impressive rally. It's the kind of movement that historically only happens when something deep is breaking in the monetary system. Let me explain why. For over 40 years, I've studied patterns that repeat throughout history. Monetary crises, empire changes, debt and inflation cycles, they all follow predictable sequences. And all these patterns are converging now, with silver at the center of the storm. The question that needs to be answered isn't whether silver will go up or down. The question is, are we seeing the collapse of a decades-long financial manipulation system, or is this just another normal economic cycle? The answer will determine whether you preserve or lose your wealth in the coming years. Today, I'm going to share something that should haunt every American who cares about their financial future. For almost 15 years, banks like J.P. Morgan were convicted of manipulating silver prices through derivative contracts. They paid nearly $1 billion in fines. Traders went to prison. But something changed radically in October 2025. Those same banks that spent years suppressing silver prices are now buying physical metal in historic quantities. J.P. Morgan alone holds more than 700 million ounces of direct and indirect exposure to physical silver. That represents almost an entire year of global production. This isn't a prediction. It's a logical consequence. When you understand the incentives, you understand the behavior. And the incentives have changed completely. History is an excellent teacher, especially when it comes to precious metals and monetary crises. What's happening with silver today isn't new. It's a pattern that is repeated for centuries. Let me show you how. In 1971, Richard Nixon ended the convertibility of the dollar to gold. It was what we call the Nixon shock. The world left the gold standard and entered the era of fiat money. In the following 10 years, between 1971 and 1981, silver rose from $1.30 to $50 per ounce, an increase of almost 0%. Why? Because when currencies lose their anchor to real assets, investors seek alternatives that preserve value. After that, we had 4 decades of systematic suppression of precious metals prices. How was this done? Through the derivatives market. Let me explain simply. Imagine there are only 100 real apples in the world, but a casino allows people to bet on thousands of paper apples. These paper bets determine the price of real apples. This is exactly how the silver market works. COMEX, the main silver futures exchange in the United States, trades contracts representing 300 times more silver than actually exists in eligible stocks. For years, major banks sold silver contracts they couldn't deliver, artificially depressing prices. But every system based on manipulation eventually finds its limits. And those limits are being tested now. And here's the point most people ignore. In December 2025, something unprecedented happened. In Japan and the United Arab Emirates, market reports indicated spot trades above $120 per ounce, while the official price on COMEX was $72, an 80% premium over the paper price. This is rare at this level, and when it appears, it's a sign of fracture in the price mechanism. It's the signal that the paper-based pricing system is breaking. Physical metal demand is exceeding the system's capacity to deliver. To understand what's happening, you need to comprehend 3 fundamental principles that govern precious metals markets. Silver isn't just a monetary metal, it's also an essential industrial input. Unlike gold, which is primarily a store of value, silver is consumed in industrial applications. Solar panels, electric vehicles, electronics, artificial intelligence, data centers, they all depend on silver. The Silver Institute reports that industrial demand reached a record 680.5 million ounces in 2024. Meanwhile, mine production remains essentially stagnant at about 835 million ounces annually. This means recurring structural deficits, which already total hundreds of millions of ounces per year. Deficits can be covered by existing stocks for some time, but eventually stocks are depleted. And that's what's happening now. Precious metals are sensitive to real yields on government bonds. Real yield equals nominal interest rate minus inflation rate. When real yields fall, investing in assets that don't pay interest, like silver, becomes more attractive. In 2025, the Federal Reserve cut interest rates twice, bringing the base rate to 3.75 to 4%. With inflation persisting above 3%, real yields are near zero or negative. This creates an ideal environment for precious metals. Something fundamental is changing in the international monetary system. Central banks around the world are buying gold and silver in record quantities. They're not buying paper contracts, they're repatriating physical metal to their own vaults. Russia announced purchases of $535 million in silver over the next 3 years. China accumulates metal through the Shanghai Gold Exchange. This represents a structural change in demand. It's not temporary speculation, it's permanent strategic reallocation. Markets can be manipulated for some time, but not indefinitely. Let me tell you a story that perfectly illustrates how these principles work in practice. Imagine a country where a single bank controls almost half the stocks of a national strategic resource. This bank spent decades manipulating the prices of this resource through derivative contracts, keeping prices artificially low while accumulating the physical metal. Then, when the manipulation system began to break, this bank completely changed strategy. This isn't a hypothetical scenario. It's exactly what JP Morgan did with silver. Between 2008 and 2020, JP Morgan was investigated, prosecuted, and fined for precious metals price manipulation. Its traders went to prison for spoofing, placing fake orders to deceive other market participants. The bank paid more than $920 million in criminal fines. But here's the interesting part. During all this time, while suppressing prices through paper contract sales, JP Morgan was simultaneously accumulating physical silver. In December 2025, the bank holds 196 million ounces of silver in COMEX vaults, representing 43% of total stocks. Additionally, as custodian of the largest silver ETF, SLV, it controls another 517 million ounces, total more than 700 million ounces. It's the largest concentration of silver